maybe the most reliable one that people have done from time immemorial is real estate investing that you talk about so much on this podcast, right? You don't have to reinvent the wheel. A million people have started, with a single family home or a duplex and moved up to a quadplex, and then they own a small, complex, and then they exchange it to a bigger complex and they buy another complex. This is a pretty tried and true formula. It's not that complicated.
Yeah.
It's going to work as long as you don't over leverage yourself or manage it terribly or whatever. It just takes time. Might not work as fast for one person as the next person, but it's relatively reliable. A startup, you're rolling the dice. You got to really love it if your goal is to do something where, less than 1% of people that tried it were successful.
Hello and welcome to the Infinite Financial Freedom Podcast. My name is Josh Metal and I am here today with Dr. Jim Dahle. I'm sure many of you know Jim. He is an emergency medicine physician and the founder of the White Coat Investor website, which is the most widely read physician-specific personal finance website in the world. It's been massively successful. Their following is incredible. I think I read online, Jim, you can correct me, but I think there's something like 200,000 unique visitors that come to your website every month. Massive accomplishment. Jim's mission and the mission of the White Coat Investor is to empower those that wear the white coat to make sure that they get a fair shake on Wall Street, which is super cool. Jim's also a proud father of 4. He spends his free time adventuring around the world. If you ever read his blog, you'll see cool pictures of him atop a mountain with his wife and his kids that are his models that he obviously pays to do the modeling of the website. That's my favorite part, by the way. If I don't read the full blog, I at least scroll through all the pictures. But it's really just been fun to watch you create what you've created with the White Coat Investor website and your community and touch so many people. And to bring your family into it is really cool. So thanks for being here. How are you today?
I'm doing great. It's my pleasure to be here. Thanks so much for your kind introduction.
You're very, very welcome. As I was thinking about this podcast and kind of preparing, it occurred to me that you have accomplished so much over the last 20 years. I think you and I had our first conversation together in either 2011 or 2012. And at that point, we were just creating Utah physician home loans, and you called and we had a great conversation. And I was thinking back around what you've accomplished over that period of time. So my first question for you is, what does the next 20 to 40 years look like for you and your family?
It's hard to say. Let me talk about the last few years, and you can relate to this, but we've been basically financially independent for 5-ish years. So I haven't had to work for money for 5 years. And yet I'm still working not one job, but 2 jobs. I'm still practicing clinical medicine. I still see patients in the ER. I had 5 shifts last week. And I'm still, running the White Coat Investor, to a certain extent. We have 15 people working here now. So I'm not nearly doing it as large a percentage of it as what I used to do. But why am I still working? Well, work has a meaningful part in my life. It's important to me. I think, contributing something to the world still matters to me. I wasn't just, running the numbers, and when I had a certain amount of passive income or a certain amount of assets that I was going to punch out, that just kind of happened, and it happened earlier than I expected it to. And I don't want to, when you have money, it gives you flexibility. You can do what you want with your life. And I don't think you should change that, what your life plans were, just because you have enough money not to do that anymore. And so I continue to work. How long will I work for? Well, I'll probably retire early. Let's be honest. I'm probably not working to 70. But who knows? I really enjoy what I'm doing right now. I might still be doing one or both of these jobs at 70. It wouldn't surprise me. But I expect I'm still going to be doing something like what I'm doing now for the next 5 to 10. Some mix of clinical work in the hospital and some mix of, making contributions at the White Coat Investor. But who knows? Life changes. I couldn't have predicted 10 years ago what I'd be doing today. So maybe my prediction for 10 years from now is not going to be accurate at all. I can tell you this, though. My dad, he retired from a state job. He was an engineer, retired from a state job at 58, 59, something like that. And then became an independent contractor, basically doing the same thing and getting paid twice as much for another 5 or 6 years as he gradually tapered down into retirement. And about the time he fully retired, his health kind of went to pot. He got this, painful joint condition called polymyalgia rheumatica, and he hasn't really had a great retirement, as far as being able to do the things he wants to do. And so when I see that sort of a thing happen, I want to make sure that I'm doing the things that are appropriate for the season of life that I'm in. There are some things that I can only do now in my 40s, and I want to make sure I'm doing those. Likewise, my 50s and my 60s. And I don't want to put everything off to the end and find out that maybe some of the stuff I really want to do in life, I now cannot do due to, whatever circumstances might come along.
Boy, I think those are some great points. And I resonate with that. I watched my grandparents who came out of the Great Depression. They started a landscaping business after my grandfather was in the military. They worked their butts off. I mean, they worked from sunrise until 10 o'clock at night. I used to work with my grandfather in landscaping businesses. And they worked all the way to the point where they got to retirement. And then my grandmother's mother moved into them and had a real debilitating medical issue. And then after, about 15 years, or maybe it was a dozen years of taking care of her, then my grandfather's health failed. And my grandmother spent the next 8 years taking care of him. And I think it's a real important point. If you can orchestrate your life in such a way that you can still contribute, you said contributing to the world matters to you. I believe it matters to all of us. And if you can orchestrate your life so that you can have a piece of retirement, you can have a little bit of freedom is what I mean by that, but you can still figure out a means by which to contribute the world. Hey, to me, that means you've made it, right? If you can do both while you still have your health, that's what winning looks like.
Yeah, I absolutely agree. If I had to write my obituary, I would want it to say that he lived a life of service and adventure. And so that's what I'm trying to do with my life, serve other people and have some wild times. So my life right now cool. Is a mix of those two things.
Yep, and just go to the blog and look at the pictures if you want to see the adventures. So let's go back just a bit. We looked forward over the next 5 to 10 years, what that might be, a life of service and adventure. Walk people through, how did you shift or transition from practicing medicine into becoming an incredible entrepreneur? Tell us a little bit about that journey, if you would.
Well, I don't know that it was a shift, right? Here's what happened. In 2011, I decided to start a blog because I got tired of writing the same tips into the internet over and over again that I was doing on forums, right? I was doing white coat investor work for many years before I started the White Coat Investor. I was doing it at the Bogleheads Forum and the Student Doctor Network Forum and Sermo and these sorts of places. And I was like, this is getting old. I'm just going to write one blog post. It's really well done and just put a link to it every time somebody asks this question again. That was the impetus. And for some reason that year, I was really excited about passive income. And I'm like, I got to get me some passive income. Blogging is not passive income, number one. There is nothing passive about it. So that was a huge mistake to think this was going to be passive income. But it was started as a business from the beginning. I was trying to make money. I put ads on the website the first week, and my kids would climb up on my knee and go, how much money did your website make today, Dad? And we'd check and it'd be $1.67 because somebody clicked on an ad, and it didn't make much money for a long time, to be honest with you. My goal was to be making $1,000 a month within a couple of years. And this is a doctor, right? I'm a practicing emergency physician. At this point, I'm a partner in my group. I can go to the hospital and see patients for 8 hours and come back with $2,000. Right. And my goal for this thing that I was pouring all kinds of time and effort into, learning all kinds of new skills, my goal was to make $1,000 a month on it. This financially did not make any sort of sense whatsoever. Right. This is a labor of love from the beginning that happened to get lucky and start making money. It was 2 or 3 years in before I really had any good sense of how to monetize the site at all. And I still don't know that I'm doing a great job with it. So, I wouldn't say there was a big shift here. I was practicing medicine full time, nights, weekends, holidays, evenings through 2016. And at that point, I just couldn't do it all. I basically had a full-time job with the white coat investor. I had a full-time job at the hospital. Something had to give, and I cut back to
Yeah.
three-quarter time. And within a couple of years after that, I dropped my night shifts. So I was only working days and evenings. And then a couple of years after that, I cut back to halftime, which is really about where I'm at right now. So it wasn't that I ever shifted from emergency medicine to entrepreneurship. I did entrepreneurship on the side. And the wonderful thing about having, not only a stable income on the side, but a good income on the side, is I had this infinite runway to get this startup off the ground. There was no
Yes.
way I was going to run out of money. It was completely bootstrapped and I didn't need the money. And so that was nice because it allowed me to make decisions about the business with a view to the long term, to preserving relationships with partners and advertisers and sponsors and staff members and that sort of a thing. And so I think that really helped us to do it the right way as we went along through the years. But yeah, it's been a really fun journey. It's been fun. Maybe one of the best parts is to create a job. We have 15 people working here now. But if you've never done this, it's incredibly rewarding to think that somebody comes in, helps you with your little side gig, and feeds their family and puts a roof over their house and pays for their retirement and sends their kids to college from some goofy little thing you started typing crap into the internet. That's incredibly rewarding. And so I really enjoy that sort of stuff. I'm not a great manager. I don't enjoy managing people. I've essentially hired that out. But I do enjoy the building and providing something for people that's, hopefully the best job they ever had.
I think you touched on just about everything I love about entrepreneurialism. And I just want to go just a tiny bit deeper there because I was involved in the White Coat Investor website in terms of sponsorship, and Jim and I had several conversations, and I would go into the blog and see the times and speed at which you were responding to the questions in the blogs, because below the blogs was massive numbers of questions. And I knew that you were working a full-time emergency medicine job. How many kids did you have at that point when you started the blog?
Well, our last one was born in 2015, so I had 3 when I started.
So dad of 3 young children, full-time emergency medicine. And I don't know what time you were answering blogs, but it appeared to me it was 3 a.m. or 4 a.m.
But it probably was at times. I mean, remember, I was up all night, right? Working shifts. And if the ER got slow, well, let's check out the blog, see what's going on. So there were times I was answering questions in the middle of the night, but I was pretty responsive to the readers. And that's how you build great loyalty and a great following. When you've saved somebody $100,000, they're very loyal to you and they tell all your friends about you. So it's, that's basically, it was built word of mouth from the very beginning.
Yep. So massive exchange of value that Jim was giving to his audience, with the hopes that one day it would make $1,000 in a month, created incredible economic goodwill. Warren Buffett talks a lot about the companies that he invests in, or the company that he admires. They have a great amount of economic goodwill. There's willing buyers out there for your product because you've created so much value for them. They're happy to exchange money with you. And what strikes me about that whole scenario is nothing was promised to you. Like, you could have put all those hours in and this thing could have been a giant failure and you never could have made that $1,000 a month. And I love that about entrepreneurs, that they're willing to lay it all on the line, put all their time into it with the hopes that this is going to be something. And when it is, it's spectacular.
Yeah. I mean, let's be fair though. I mean, yeah, I was only making $1 a day for a while, but I could see the growth, right? I liked the direction it was going in. It wasn't making much money, but I liked the direction it was going. So that helped to stick with it. When you're making, twice as much in a month than you were making 3 months ago, when you're seeing that sort of growth, you wonder how much higher can this go? And every year, Katie and I'd look at each other and go, can we double this thing again? And
You
we're not
did.
growing at that rate anymore, obviously, but for many years we grew at 80%, 160% a year, and it's pretty exciting when you're seeing those sorts of numbers. Even if you're starting at $5,000 or $20,000 a year, it's pretty exciting to see that sort of a rate of growth and wonder how far it's going to go.
Well, and I'm sure how many people were visiting your website, because I remember at one point, I think you had a tracker in the body of your website that showed like over 1 million views or something like that. Am I remembering that correctly?
I don't know. It might have been a tracker that people subscribe to the newsletter or something. I can't remember,
Okay.
but
It was
we
just
were very, very transparent for many, many years on what we were seeing traffic wise, where our money was coming in from, and that sort of stuff. After it reached a certain level of success, I dialed that back a bit because I was afraid my kids were going to get kidnapped. And so we actually became a little less transparent. We were also inspiring a lot of competition, which was probably not the best thing to do, to give out your blueprint to your competitors. But so we dialed that back a little bit, probably 4 years ago or so. We're a little less transparent on that sort of stuff. But for many years, it was, the blog readers were right there along with us on the journey.
I remember reading the annual year-end summaries that you would do for many years. So I remember that. So my guess, and we didn't talk about this, so correct me if I'm wrong, but my suspicion is that if you analyzed all the investments you've ever made over your entire lifetime, the highest return on investment of any investments has been the investment in yourself, meaning the financial literacy, the medical education. And I find that a lot of times, like, I'll be working with somebody and talking to them, and I'll go, well, have you ever gone to an in-person seminar? That one's going to cost you $2,500. They're like, oh no, I'd never spend $2,500 on it. But they would put $2,500 in Bitcoin today, or any investment. So can you speak to that a little bit? First of all, am I right that that's the best, highest return on the investment is yourself? And any thoughts you have about investing in your own knowledge?
Well, for sure, that's the best investment, especially for somebody in their 20s or 30s, right? When it increases their ability to earn down the road, or even just their ability to manage their money better down the road. Those are smart investments. I basically dedicated my 20s to medicine. 4 years of college, 4 years of medical school, 3 years of residency. By the time I came out of the medical training pipeline, I was 31 years old. And did I do some other stuff during my 20s? Yes, but the lion's share of my 20s were dedicated to medicine. And what did that allow me to do? Well, once I got done paying for that education, right? The military was only paying me about $120,000 a year. I essentially had the ability to trade my time for money at a very high rate. A typical partner in an emergency medicine group like mine that was working full time, that's probably a $400,000 a year job. And so that's what my investment in my time earned me. And you can have a very nice life on $400,000. You can create a substantial nest egg on $400,000. You can build all kinds of wealth on $400,000. And so, yeah, I mean, that's probably, the best investment I made in myself. As far as the white coat investor, putting that sort of time in. Now, the education I put in that I share with my blog readers and podcast listeners and YouTube viewers and those sorts of things, that was very valuable. That I just got on the side, and I got it very inexpensively as far as money. Most of it came from reading books, half of which I probably just borrowed from the library, and most of the rest from interacting with other intelligent people on internet forums. After a while, when you're on a forum, you know the answers, and you find yourself teaching a whole lot more than you're learning. And so that education also paid off in spades for me. But as far as, starting the white coat investor and that being, the best investment ever, that was, not financially the riskiest thing I ever did, but probably the least likely to succeed thing I ever did. I mean, I have watched, 130 physician financial blogs come and go over the last 12 years. I would say that 3 of those have made, maybe 4, have made enough money to justify the time the person put into it. meaning that eventually they made, $100,000, because these are physicians doing this, right? They have a very high, opportunity cost to be spending time with a blog. Now, as I look at those, two of them aren't even really blogs anymore. They do other stuff, podcasts, sell courses, whatever. One of them is no longer owned by the physician who started it. And there's the white coat investor, right? The other 126 are basically, from a business perspective, failures, right? And they didn't all start it as a business. Some of them, it's a labor of love, and that's fine. But from an entrepreneurship perspective, those are not good odds.
No.
This is not something I can recommend to people that they do, right? And should everybody go out and be a startup entrepreneur and this is the pathway to wealth? That's very hard for me to recommend to people. It's especially hard for me to recommend to doctors because the opportunity cost is so high. Whether they are a pediatrician making $225,000 a year, or like the orthopedist I talked to this week that's making $1.6 million a year, telling this guy that he ought to go start a blog, because it'll be more passive and it might go big. No, that's stupid advice. He should not do that. He should, continue doing his practice and carve some money out of his earnings and use it to invest in, some reasonable investments. That is a far more useful pathway. Like I've been telling people for years, I talk about, it's not guaranteed, but it's awfully low risk to be a doctor, go work hard, make your money, carve out 20 or 30% of it every year, invest it in a boring portfolio of index funds. And after 20 or 30 years, you are going to retire a multimillionaire. It's almost guaranteed. And it's very easy, right? So that is the background. Before you recommend any sort of entrepreneurship to somebody, that's what you're comparing to. And that's a high, hurdle to get over for a doctor. Now, somebody that's like my daughter, right? My daughter was pre-med for about 2 weeks in college. Now she is a business major with an emphasis in entrepreneurship. Her opportunity cost is not nearly as high as that orthopedist that's killing it, And so I think those risks for her are a lot more worthwhile taking. But even so, even if you've decided I'm going to dive into this pathway of entrepreneurship, a startup, like the white coat investor has got to be the riskiest way to do it. There are far less risky ways to be an entrepreneur. I look at franchises. I had this guy on my podcast a few months ago that did non-food franchises. That's what he did. And I've had a few doctors go and try that. And you know what? It's pretty straightforward. You do what the other people that were successful with it did in a new area. And this gutter business, it's gutters, for roofs. That's what the business is they started. And they're doing fine. They're right on track with what all the other people did. They're going to have their third truck done this year, in less than a year. They'll have 3 trucks out there installing gutters on houses. And it's relatively, much less risky, I think, than a startup with a new idea or a new product or something like that. Maybe the most reliable one that people have done from time immemorial is real estate investing that you talk about so much on this podcast, right? You don't have to reinvent the wheel. A million people have started, with a single family home or a duplex and moved up to a quadplex, and then they own a small complex, and then they exchange it to a bigger complex and they buy another complex. This is a pretty tried and true formula. It's not that complicated. Yeah. It's going to work as long as you don't over leverage yourself or manage it terribly or whatever. It just takes time. Might not work as fast for one person as the next person, but it's relatively reliable. A startup, you're rolling the dice. You got to really love it if your goal is to do something where, less than 1% of people that tried it were successful.
What I'm hearing from you is gauge your opportunity costs. And if you decide to take that risk, don't quit your day job until you've made at least $1,000 a month in your side hustle.
Dave Ramsey has a good analogy that he'll throw out every now and then on his show, whether you like Dave or not, or, he says a few things that are pretty useful. And I like this one where he tells people that want to be self-employed, get the boat close to the dock before you jump. And what he means by that is, well, how's the side hustle going? If your main gig's paying you 50 grand a year and this side hustle is now making 35, well, you can probably make the jump into the boat. but don't jump into the boat when that thing's making, $4,000 a year. It's too far from the dock. And I think it's the same thing with entrepreneurship, not just, self-employment. You want to make sure this thing's probably going to make it before you quit the day job. Otherwise, it's a huge risk in your life. And, most of us, depending on how much money you got from your family and what your spouse does, we probably should not be taking risks like that in our lives.
Yeah, it's a great point. And I think the same way about real estate investment. When I was 21, I think my mom and I bought our first investment property. We would take risks at that age that I would not take now because the consequences were smaller. If I'm going to make a mistake, I want to make it on an $80,000 condo, not an $8 million retail building, right? I want to make those mistakes early when the consequences aren't as big, and then get more conservative as I go down the line.
Well, plus the utility of that extra money, that extra earnings, that extra income was far higher back then, right? When you're living on $35,000 a year, $5,000 more income changes your life.
Right.
When you're making $250,000 a year, $5,000 more in income is not changing your life. Maybe you give a little more to charity, you pay a little more in taxes, but it doesn't change your life. And early on it does. So, and you got more time to correct your mistakes. Sure. Your mistakes are with smaller amounts of money. Sure. But mostly I think it's just worth a lot more to you then.
Great point. Can't disagree with that. So you hit on two different things, and it reminded me that when I first started following the blog, which is, I think when you created it, I was right from the beginning. I was reading
Josh, you were at one point my biggest advertiser. I might not have even been making $1,000 a month before you came on. You had the banner ad at the top of the site. I remember we had to go to you and we removed that banner ad and say, Josh, we're not going to have this ad anymore. I know you've had it for the last year or two, but we're taking it off the site. And I don't know what you were paying for that ad, but you were a significant chunk of the revenue at that point. So you were definitely early on.
I was getting my money worth, not just from the referrals for medical professionals we got to work with, but it brought me to the blog. I read it every day when a new blog came out. My financial IQ was worth what I was paying in advertising dollars, I'm sure. So when you started the blog, the vast majority of the advice, as I recall, was around index funds, living like a resident for a couple of years after you finish residency, HSAs, IRAs, right? It was really what I would call traditional investment advice. And as of the last year in particular, I've started to see you talk more about cash flow opportunities like real estate investments. I believe I even saw a couple of segments on debt investments. So talk me through that evolution. Is that just because that's followed your investing evolution as you built your foundation of index funds? Or how do you think about that today?
Well, I think there's a few factors there. I've had a few people mention that to me. And I think what most people are noticing is a new product line we have at the White Coat Investor, which is partnerships with real estate investing companies. And that has really ramped up over the last 2 to 3 years. When we brought on our COO, that was kind of an assignment that we need to make this more of a product line. We also released our real estate course last year. And so I think, in the 6 months leading up to that and the 6 months afterward, there was a pretty heavy real estate focus on the blog because that's what I was doing. I was making a course. So I was thinking about real estate. I was writing about real estate. I was podcasting about real estate. And so I think that's part of what people are seeing, and they're interpreting it as some sort of evolution that I'm not sure is really there. This is especially true if they're signed up for one of our email lists. Most of our email lists are pretty darn educational. The ratio of education content to monetization and sponsorship is pretty darn high on most of our email lists. That is not the case for one of our email lists, which is our real estate opportunities list, which is probably 95% promotional. We tell people, if you want to hear about real estate opportunities out there, sign up for this list. And we do some educational content there. But a lot of it is, promotion and introduction to some of our real estate sponsors. And so if you're getting everything we send out, you're seeing a pretty healthy dose of emails designed for people on that list. And that could easily be interpreted as there's a huge focus change. Now all we talk about is real estate. And in reality, this is just one of our product lines. We've got mortgage loans and student loan refinancing and insurance and real estate investing. And so that would feel like there was a big shift. The only real shift I've had in my personal investments probably happened in 2016-ish, maybe. And I basically went from having a portfolio that was 7.5% real estate to 20% real estate. That's it. So did I go into a little more real estate? Yes. I basically took some of the money I had invested in stocks and put it into real estate. But my portfolio is still today 60% stocks, basically entirely in index funds, 20% bonds, in similar index-like investments, and 20% real estate. Now, of that 20% real estate, about 5% is in publicly traded REITs. And prior to that shift in 2016, all 7.5% was in publicly traded REITs, or almost all of it. And now I've got 5% in publicly traded REITs, 5% in debt, private debt investments, funds entirely, and the other 10% in private equity real estate investments. Some syndications early on, but now almost entirely funds, just because I prefer the diversification of funds. So that's basically what I'm investing in. About 20% of my money is invested in real estate. Very little in what I'd call direct real estate. There's one syndication, basically the office building for the physicians in my partnership, where I manage the syndication. So I guess I'm a syndicator now in some ways. But everything else is very passive. It's mailbox money. So, and even the one thing I'm managing is a bit of a pain. I had to transfer a bunch of money around yesterday for it. And I'm like, why am I doing this? And we've got a property manager, and it's one property with two tenants, one of which is our partnership. It's not exactly a lot of work. And I still look at it going, why am I doing this? But, that's, I think the evolution, if you've seen any, is there. But I wouldn't say that my focus has dramatically changed. I think I've always had respect for real estate investors because I just met too many that did just fine. But you got to keep in mind what you're comparing to. This other system, if you want to call it that, for doctors, these people making $200,000, $300,000, $400,000 a year, carving 20% of it out a year, dump it into a boring portfolio of index funds, is so reliable and so easy that you've got to really want something else in order to do anything else. And I think when you start looking into real estate investments, whether they're relatively passive or relatively active, you've got to ask yourself, do I really want more than that? Am I willing to put in the time to get the education and to do the management and the tax hassle and all that sort of stuff in order to have more than that? And a lot of very logical people look at that and go, yes, I do. And other people look at it, understand it, and go, no, I don't. I'm not into this. And that's fine. So I just try to introduce people to it, teach them about it, and some will choose to go down that path and some won't.
I love it. That was super helpful for me. Let me actually share a quick story, because this is a bit of a philosophical question that I want to ask you and get your opinion on, and something that I've been wrestling with for a long time. And we talk about it a lot on the podcast, but I recently was talking to a person who had about a $5 million portfolio of mostly stocks and bonds, index funds, that kind of a traditional investment portfolio. And they found themselves, definitely in the second half, maybe the last third of their professional career, winding that down. And they were really struggling with the market correction of 2022. They were very concerned around the direction the economy is going in 2023. And the construct around having this nest egg that they, plan to support them in life throughout the rest of their life, and seeing the value of that nest egg potentially go down as they entered into retirement, you could tell that they just were really struggling with that. They weren't enjoying that orientation of their retirement sustenance. And the question I had in my mind was, well, if that person had taken those funds and put them into something that was a cash flow producing instrument, so that could be a franchise, as you alluded to, the rain gutter business. That could be private money notes or some other debt investing. It could be real estate syndicates. It could be buying a couple of single family homes or small apartment buildings, whatever. But whatever that vehicle is to create cash flow, it seemed to me that perhaps maybe a mix of the cash flow with the nest egg in savings would have provided them a little less stress. What are your thoughts around that? Is that part of why you've moved a larger proportion of your investments towards real estate and cash flow producing assets, or how do you think through that?
Well, that certainly isn't a reason why I changed my investments. The reason I invest in real estate is twofold: high returns, low correlation with my stocks and bonds. That's it. That's why I invest there. Cash flow is not a good thing for me, Josh. I pay 45.5% on ordinary income. I don't need more cash flow. I've got more cash flow now than I'm spending every year. Cash flow is not good for me. So this idea that cash flow is always awesome and cash flow is the best, that's not true, right? It is far more tax efficient to get your returns, assuming the returns are the same, to get your returns in the form of long-term capital gains for a few reasons. One, if you don't want the income, you don't have to take it, right? It's completely optional. You get to declare your own dividend whenever you want. Two, when you sell, you pay a long-term capital gains rates. That's a maximum 23.8% if you include the Obamacare taxes. For a lot of people, it's 0%. 0% capital gains rate bracket is huge right now. Lots of people can live off capital gains, have no income, pay no taxes. And also, anytime you sell something that has capital gains, part of it's principal, and you don't have to pay taxes on that at all. So, this idea that cash flow is always awesome, I always like to push back on that because I think it's short-sighted. Now, all that said, I think if you're going to invest in stocks, you need to understand what stocks do. And I think it was JP Morgan that said famously, what's the market going to do? And he said, it will fluctuate because it's going to fluctuate. Too many people don't look at the history, financial history, market history, and understand what stocks do. This is what they do. They go up 30% in a year. Then the next year they're down 8%. Then the next year they're up 4%. The next year they're down 20. The next year they're up 25. This is what stocks do. And you cannot buy them thinking this is like a savings account. It is not like a savings account. In good times, your stocks are not worth as much as you think they are. In bad times, they are not worth as little as you think they are, right? And you've got to keep in mind, this is an investment you make for 10, 20, 30 years. And over 10, 20, 30 years, you're going to make money. But if you are watching this thing daily going up and down and CNBC, you're going to go crazy, especially if you're doing individual stocks instead of some boring, broadly diversified index funds. So if you're going to invest in stocks, yes, it's easy. Yes, it's very straightforward, but you still have to stay the course. You still have to be able to be a good investor. And the investor matters more than the investment in a lot of ways. So if you can't do that, you've got to find something else. But I think most people can, with an appropriate amount of education, occasionally with the use of an advisor to help talk them through the downtimes. But it's a disaster to sell your portfolio low in a 2008 or 2020 or a 2022 bear market. That's a disaster to let everything fall 30% and then sell it, when it's a much better investment than it was before. It's just silly. So you've got to get control of your stock market behavior if you're going to invest in the stock market, number one. The other thing I think that should be talked about anytime you talk about, just living off the cash, right? Because this is a lot of people's idea of retirement. Well, I'm just going to spend the dividends, or I'm just going to spend the rents, or whatever. Well, if you do that, you have, by definition, oversaved, and you are underspending because you are not immortal. You're not going to live forever. You will die at some point. And if you are only spending the income, I hope I'm your heir. because there's going to be a lot of money left behind. That's especially true in stocks, where maybe if the return's 10% on stocks long term, maybe 2% of that's income, 8% of it's capital gains. So if you're only spending the dividends from your stocks, your heirs are going to be left with some huge multiple of what you retired with. And so that's great for them, but it means you spent too long working, you spent too little in retirement, because you can spend principal. You're not going to live forever. You just have to be careful how much you spend, right? And the truth is, you've heard of these 4% withdrawal studies. If you take out 4% of your initial portfolio, adjusted upward for inflation each year, on average, you die with 2.7 times what you retired with. The reason you're only taking out 4% is for that very small percentage of, bad sequence of returns that you get early on. That's why you're only taking out 4% instead of 5 or 6 or 7%, which would work most of the time. So keep that in mind as you only spend income, that you're leaving a lot of money behind, and you better be okay with that. And some people are wealthy enough that they're fine with that. They're living their desired life on just their income. Now, the nice thing about these income focused investments, real estate's the classic example. The nice thing about it is, your return might be 10%, just like that stock market investment, but 3% is from capital gains and 7% is from income. And so you feel like you can spend more of it, but in reality, it's all the same thing. Money's fungible. You can take your $500,000 in index funds and turn it into a rental property. You can take your rental property and turn it into $500,000 of index funds. It's not like you're locked into one or the other. Yes, there's some tax consequences to changing, but you're not locked in. You can change your mind at any time. And so I think there's some benefit there if you're actually spending from your portfolio to get a lot of it as income. I think psychologically, it gives you permission to spend a little more than selling shares, which I think a lot of people have a hard time with.
Yep.
But in reality, this is the same thing. They're two different investments. Obviously, it's hard to sell off one of the 16 apartments in your complex and spend that. But like you could, one of your 16 shares of a stock. But for the most part, this is the same thing. And I think it would help a lot of real estate investors if they thought of it that way. Because if you're just going for this income, it means you're working longer than you have to.
Yeah. Great points. And I'm reading right now The Intelligent Investor by Benjamin Graham. I think I read it when I was in my 20s and forgot most of all the wisdom that was in there. But one of the things that he says is, you paraphrased it, right? It's more the investor than it is the investment. And along that line of thinking, I've thought many times, as I'm watching a rental property, as long as it's spinning off a positive cash flow every month, I have zero thought about what is happening to the value of that property. Is it going up? Is it going down? I really couldn't care, because the longer the period of time goes, the more of the amortization is going towards principal versus interest. I'm getting some depreciation. I have cash flow. Like, I just never think of it. But I see, it seems to me at least, that the people that I know that have the vast majority of their, or actually all of their savings in stocks, are more inclined, or even a stock and bond portfolio, are more inclined to check their mobile phone for valuations, more inclined to kind of fall into that bad investor behavior. So do you see that? Are there tips which you can disassociate yourself from checking your portfolio and making that decision, as you alluded to sell when the market's down 30%? What advice do you have there?
Well, that may be true. And that's an important consideration for people investing in real estate, right? Be cash flow positive. You can have an infinite number of cash flow positive investments, but you got 4 or 5 cash flow negative investments, even if you're a doctor, and all of a sudden you're laying awake at night,
Yep.
So put enough money down that you're cash flow positive. That's the main way you get to cash flow positivity, is just putting more money down. But as far as helping people to kind of stay the course, after 2008, stock market investing has been really boring for me. I watched in 2008 pretty closely, and I didn't have that big of a portfolio. My total losses in the 2008, 2009 bear market were $78,000. That was it. That was all I lost. because I just didn't have that big of a portfolio. And but I watched it, and it was a wild ride. I mean,
Yeah.
things like the Vanguard REIT Index Fund, that thing was going up and down 5 to 10% a day,
The
a
day.
day, you know? And I think it dropped 78% of its value from peak to trough. I mean, that's a huge loss in value.
Massive.
After that, it's boring to watch the stock market. Oh, whoop-de-doo. It went up 1% this day, it went down 10%. Who cares? It's boring. So maybe watch really closely in your first bear market, and then you stop looking. If I didn't do a newsletter every month that reported the returns of various, asset classes, I don't think I'd look once a month. I'd probably look about once a quarter at the markets, because I don't care. Just like you don't care about the value of that property. You're certainly not going to pay for an appraisal every month. Just like you don't care about that. I don't care about what the stocks are worth today, or what they were worth last month, or what they're going to be worth a year from now, because I'm not selling it a year from now. Just like you're not selling your property a year from now. What I care about is what it's worth in 20 years, because that's likely when I'm selling some of it. And some of it I'm not even going to sell then. I'm going to spend it in 40 years, or I'm going to leave it to my heirs, or I'm not even going to leave it to anybody. I'm giving it to charity, And so you just got to develop that mindset. The investor matters more than the investment. And if you're going to be a stock market investor, you got to figure out how to be a stock market investor. And I can tell you, the key is not in having the app on your phone that you can log into all day long to see how your stocks are doing. That sounds like a crypto asset investor to me. And maybe you do have to watch your crypto that closely, because it's always imploding, but you certainly don't have to watch stocks like that.
I think
but there's this.
is...
You've heard this apocryphal study, right? That Fidelity supposedly did, where they determined which of their investors did the best, and it was the ones that were dead.
The dead ones, yeah.
They hadn't looked at their account in years, and so there's some truth to that when it comes to stock market investing. Just leave it alone, and let it do its thing over years.
That's such great context. That is really helpful. And if anybody doesn't know what study Jim's talking about, literally they set out on a research project to figure out, like, who are our most successful investors that have the most amount of appreciation in their assets. But the dead ones, because they can't trade their stocks. It's such a great lesson. I love that. Okay, you reminded me earlier in this podcast that I was going to die. So thanks for
sorry about that.
Yeah, thanks for the reminder. And I think a lot about inheritance and what inheritance means to me. And I came to a place where I realized that for me, yes, there is a money portion of what inheritance means to me, but that's like the 20% of the 100%. The other 80%, in my opinion, is the lessons that we teach our children that enabled us to become successful and to grow the money portion of the inheritance. And I think that sometimes people spend 80% of their thinking or mindset around the money part and only 20% around the lessons part. I have a feeling you're doing that very differently with your kids. And so I'm just wondering if you could comment on your thought process around that.
Well, I mean, the first thing when you look at inheritance is we all think about money. And the truth is, the money is maybe the least important thing I'm passing along to the kids. Even financially speaking, it's the least important thing, but mostly non-financially speaking. Every morning we're up, reading with our kids before they go to school, generally reading some scripture and trying to pass along our values to them to help them be good people. And I hope that inheritance is far more valuable than any money they get. But as far as speaking from a financial perspective, the best thing you can do with your kids, as far as teaching them about money, is talking about money. It's okay to talk about money at home. Some people don't talk about money anywhere in their life, and they're hesitant to do it with their kids. You never talk about money. All they're going to learn is, that it's something you don't talk about, and they're likely to make the same mistakes you and carry all kinds of baggage from that, So I think you absolutely do need to teach them about money. Now, my kids hate being taught about money. They hate it. I'll turn on a podcast, make them listen to it, and they'll be screaming that it's bloody murder, Or I try to teach them what an index fund is, and the 16-year-old and the 14-year-old could care less, And so you got to slip these things in. As I'm driving down the road, I point out that their 529 owns Home Depot, and it owns McDonald's, and it owns Exxon and BP and these
That's
companies.
cool.
And then, 3 months later, there's a question. What do you mean I own Home Depot? And then you've got an opportunity to teach. So it's a little bit tricky, I think, giving them an allowance, that sort of thing, let them spend some money and make some mistakes. Well, it's tiny amounts of money, encouraging them to get summer jobs, even though your family can afford for them not to have it. All these lessons, I think, as you're transmitting them are really useful for sure. But as far as about the money, the actual money you're giving them, I think you have to be really careful, because you can screw somebody up really badly by giving them money that they're not prepared to receive. I just think even about myself, and this is about money I've earned, this is money I made. It screwed my life up in some ways, Has it affected my work ethic? Absolutely. Right. I definitely worked harder when I was hungrier for money than I do now. And I can't imagine if somebody gave me a large sum of money at 20 or 25 or even 30 years old, how that would affect what I've chosen to do with my life. So in our financial plan, in our estate plan, we basically set up a couple of things to help guard against that. The first one is all our kids get 3 pots of money, basically, one of which is a Roth IRA. So any money they earn during their teenage years, we match in a Roth IRA. And so that's added up to some over time. Another pot of money is their 529. This is college savings. I want them all coming out of their education debt-free. It's just such a huge impediment these days to people's lives to come out with debt. And we have enough money. There's no reason my kids should have educational debt. So there's a 529. But the third pot is very interesting. It's in a UTMA account, Uniform Transfer to Minors account. And it is what we call the 20s fund. And this is money they can use for whatever they want in their 20s, whether it's a mission or whether it's a summer in Europe or whether it's a car or a down payment on a house or whatever. And we get to watch what they do with it. And that's going to tell us a lot about how they're going to manage their eventual inheritance, which is likely going to be far more money. So that's number one. Number two, they don't get their inheritance until they're 40, 50, and 60. So they get a third of it at 40, a third at 50, and a third at 60. That does a couple of things. Number one, it gives them 20 years to do their thing, right? You can't go 20 years without a career. You got to do something with your life, right?
Right.
And so I like that perspective. Whether we're alive or whether we're dead, they're not getting squat till they're 40, other than that 20s fund. The second thing is, even if they totally botch it, 10 years later, they're getting it again. And 10 years after that, they're getting it again. So it's kind of a 3 strikes rule there. And who knows, maybe they're going to show they're terrible with money using their 20s fund, and we'll change that so it's, an annuity they get rather than a lump sum of cash. But that's our estate plan. We'll see how it goes.
That's a fantastically engineered plan. Yeah, to your point of getting their interest, my kids, I would talk about finances, and mom would come over, and my wife, we're all in the family business together, and we talk about investments, and it was like nails on a chalkboard to those kids. But I'll tell you what, the first moment that they had $1 green dollar invested in any one of those properties, you could get them to sit through 50-minute discussion and they had questions. So in closing, I would just add to your point, once kids feel they have a skin in the game, whether it's investments or entrepreneurial lessons or anything, boy, it's amazing how they get interested and start asking questions. And that's where I think a lot about, it's on me. I have the responsibility to transfer more information than I will money. And it's something that I think about a lot. I love the approach that you took. So thanks for sharing that. Jim, we've done it. This has been incredible. I really appreciate your help. You are inspiring and informative all at the same time. I will send people to your website, whitecoatinvestor.com. I don't believe there is a better free resource on the internet when it comes to personal finance. There's all kinds of communities you can join in there. Is there any other place that people can find and follow you, Jim?
Well, I think the important thing to know is that we try to give you this information in whatever format you prefer. So if you like a podcast, we got a podcast. You like video, we got YouTube. You like a forum, we've got a forum, books, courses, conferences, whatever. Is it the information the same? Well, mostly, yes, it is. So however you like to get it, just search White Coat Investor in that format and you'll find us.
Two other things I'm just going to add about your website. Number one, the search function works very well. So if you want to know about HSA accounts, because you've heard it a million times and you've never done it, go search for HSA. You'll find a bunch of articles and super valuable. The other thing I would recommend is sign up for his newsletter. You'll get the monthly report that's kind of an overall summary of what's going on in the markets. You can sign up to get the daily blog notifications, but go get active on the site and you'll be a smarter, more financially literate individual. So with that, thank you so much for being here. True pleasure. And keep making people more financially literate, my friend.
The pleasure is all mine. Thank you for having me, Josh.